Good morning, everybody, and welcome to this session as part of a series of dialogues being held by TIPS and the EU, an opportunity for peers to talk to each other and for us to learn a little bit more about finance, particularly in the context of a project that TIPS are running on a just transition finance roadmap. And so obviously that involves two key sets of communities, both the just transition community, but also the finance community. So perhaps just some words of introduction and context. The South African social context is really important. Obviously, we have unacceptably high levels of inequality, unemployment, and poverty, some of the highest in the world. We're also extremely vulnerable to climate change and the impacts of climate change, both from a physical climate change perspective, but also from a transition perspective. And we see that transition risk playing out in two important ways through trade. First, changes in commodity demand patterns globally, and therefore the demand for the kinds of commodities we produce. And South Africa produces commodities that are particularly vulnerable to climate change trade patterns, and then of course to also border tariff adjustments. And so, for example, the EU are considering implementing border tariff adjustments as early as 2022 or 2023, and that may then also impact our ability to trade with these partners. And so in that way, climate change becomes a very economic issue. But perhaps to bring us back to this idea of a just transition, the NBI, the organization that I work for, has been leading some research on just transition zero carbon pathways across various sectors in the economy. And one of the sectors we've looked at is agriculture, forestry, and land use. And there we had some stats that I find really quite shocking. The average household in South Africa spends about 1,000 Rand a month on food, which is about 2,000 Rand short of the amount you need to spend to get a nutritious food basket. So 3,000 Rand is really what you need to spend to have a nutritious food basket. And you need to spend about 4,000 Rand to have a nutritious, climate-friendly food basket. And so in that sort of transition from where we are now to the future that we want, we both need to deal with these climate change issues, but the underlying dominance is we also need to deal with these social issues of poverty, inequality, and unemployment. And that's really when we start to have this debate about a just transition, right? And that then pulls in the finance sector. Because when we finance projects and we think about transactions, how do we introduce this concept of just transition into a sort of transactional level thinking? And when we talk to the community, we get sort of three buckets of barriers. There are project barriers. Well, what is a just transition transaction? What would a just transition project be? Don't I carry a whole bunch of reputational risk? If I claim that a project is a just transition transaction and someone objects publicly, then I'm accused of just transition washing, a new kind of washing. There's no pipeline of projects is something we commonly hear. And if there are projects that are too small or they're really fragmented, another barrier of, or a bucket of barriers is do we have the finance mechanisms? Is there enough innovation in finance? Is there enough capital available? There are issues around perceived performance of just transition projects, that they will potentially do worse than other projects. And then there are a range of issues around capacity. Do we have the internal capacity within our financial institutions to understand these transactions, within our project development community to make sure that they position these projects well? And so today we want to talk about a bunch of these barriers and potential solutions in the context of institutional investors. And so we have a wonderful panel of speakers that I'm sure you will all be very excited to listen to. And I will introduce them in slightly more detail as we go along. But our speakers for today are Deepak Patel, who works for the Presidential Climate Commission and leads the climate finance work there. Nazmira Mullah, who is head of investment, South African investment at 91, big asset manager. Sean Kidney, the CEO of the Climate Bond Initiative. Johan Florin, head of communication at ESG 87. And Sari Tassa, senior advisor to the Finland Ministry of Economic Affairs and Employment. So a really interesting session. Each of our speakers is going to speak for about 10 minutes, and then we'll have a session at the end for questions. For those of you in the audience, if I could please ask you to put your questions in the Q&A box of the Zoom interface, and then we'll be able to share those questions with speakers as we go along. So without much more introduction, I'm going to invite Deepak to speak first. Deepak has a really great experience in the financial services sector. He is currently, as I said, working for the PCC, leading the finance work there, but in the past has held various government positions, advising the DTIC. He was the Director General of the National Department of Transport, has held various investment banking positions at Standard Bank, including the Global Head of Structured Project Finance and the Global Head of Transactional Projects. And so a really good finance background, as well as a keen understanding of climate change and the just transition. Perhaps one of the most important components of his profile is that Deepak is also an accredited brewer, which is something I intend to take advantage of in the future. Over you to you, Deepak.
Thank you very much, Steve. I wouldn't say I know too much about climate, etc., but it is something that I'm learning very, very quickly. If you don't mind, I'm going to share my screen, and I hope I get this right. Is that good?
Perfect, thank you.
Good, thank you very much. And colleagues and friends on this call, I'm going to try and whisk through what I consider to be key issues, including positioning the Presidential Climate Commission, as well as try to go through some of both the philosophical and definitional aspects of a just transition as we're developing through the PCC a consensus on those issues. And then if time allows, I also want to just look at the regulatory, financial, prudential landscape, which I think is going to be quite key to ensuring that as we undertake this transition, we're able to package, as Steve has already said, the challenges that exist in the financial as well as transactional environments, to try to look at what the key issues are that we might need to transform and change in both our approach to investments and returns, as well as in the prudential and regulatory environment, including, of course, a transformation of the way in which the financial industry and the investment fraternity looks at risk. The PCC, as most people would know, was launched by presidential decree, with the president being the chairperson of it in December. It really hit the ground running in February of this year. And since then, I think with very limited resources and no real executive authority, has achieved quite a bit. We're in the process of developing with stakeholders and our social partners a common vision for a just transition, and we're quite far down the road together with TIPS and NBI, in some ways partnering and leading as well, to developing a real keen understanding of what a just transition would look like as we undertake this journey towards net zero in 2050. At the moment, our power lies in our ability to recommend various pathways, whether that be mitigation, adaptation, as well as industrial pathways to lead the process towards decarbonization. But just as importantly, I think we need to embed a just orientation as a key factor in these pathways. We do know that as we move away from coal as a primary energy source and other fossil fuels thereafter, that jobs and livelihoods get threatened, and we need to find a way in which to ameliorate the negative impacts as we undertake this transition. Technology, as we know, I think is going to be quite key to ensuring that we take full advantage of the capabilities that sit both in our industry and our research and development capabilities in the country, so that we're not takers of other people's IPs, as well as we move up the technology curve, how to find ways in which to finance, provide capital in this move towards higher technologies. Finance, absolutely key, because as we know, unless we're able to speak to investors, whether they be debt providers or equity financiers or long-term institutional investors, we need to find a way in which to harness and package through instruments as well as through risk mitigation, an environment where there's a ready a readiness on the part of the financial industry to participate in this. And then, of course, monitoring and evaluation, absolutely key as we make the commitments, which I'll talk to in a second, to the global community as well as to our own local communities and constituencies, a need to monitor and evaluate as we proceed down this road. It's quite interesting to and to establish what we've committed to or about to commit to as we go to COP26 as a country. Cabinet on the 14th of September made a decision with respect to a second nationally determined contribution, or those in the climate environment know it as NDC. And it's quite interesting to note that Cabinet has expressed greater ambition in both the lower trajectory as well as the upper trajectory in the range of commitment. And in 2016 at Paris, we had committed as a country to be in a range of 398 to 614, and that's million metric tons of CO2 equivalent. We've tightened that now, firstly, but secondly, we've also provided interim ranges, which means that we're not only going to reduce the upper band and tighten its relationship with the lower band, but it commits us now to a pathway that has decarbonization as a critical element of everything that we do, whether that's social development, economic development, as well as our industrial parts. What is a just transition? It's quite interesting to note that, in fact, the notion of a just transition in the first instance arose through a COSATU-sponsored perspective on this issue. And since then, it has been adopted in a variety of different places, including the International Labour Organization. Our own National Planning Commission says that we need to place the poor and the vulnerable at the very center of a transition to net zero by 2050. And there's an emphasis on affordable, decentralized, and very importantly, diversely owned renewable energy. What this does is sketches a pathway, at least with respect to energy and power, a sense of what the future sector would look like. There have been many NEDLAC discussions on the climate change bill, which was also adopted by Parliament, adopted by Cabinet as a bill and will be introduced in Parliament in the next short while. And that will also then set the stage for really a legislatively grounded commitment that we make to a net zero pathway. I just want to indicate that some of the work that we've done with NBI and TIPS has also led us to believe that there are three elements to a just transition, the way we see it in South Africa, and that is procedural justice, distributive justice, and restorative justice. Procedural justice focuses, of course, on the processes and the way in which we facilitate a transition and ensure that we do this in an inclusive and fair manner. Distributive justice deals with the allocation of resources as we make this move, and therefore the availability of both financial and other types of resources to ameliorate the negative impact on communities, workers, as well as the supply chain, smaller and medium-sized businesses, as they effect this transition, need to be taken into account. And then, of course, restorative justice relates to the past, the present, and the future, both in terms of how societies will be impacted and how we can not only ameliorate, but in fact, to put it quite bluntly, find a way of compensating societies and communities that will experience a negative impact. I'm going to oversimplify this potentially at the risk of upsetting some of our more financially capable and literate members in the audience, but it's important to understand what is climate finance. Climate finance is the mobilization of finance for climate outcomes, and these outcomes fall in a number of categories. I would argue that in South Africa, this is mitigation, adaptation, as we've discussed, to ameliorate and in fact deal with some of the social impacts. And then finally, the negative impacts on workers, communities, and local economies not only need to be ameliorated, but we need to find a pathway of growth as we undertake this transition to net zero. And that requires then financing of various types of activities that might not be the forte or within the purview of the financial system and landscape as it currently exists. Sources and application of types of capital, there's obviously global versus domestic, there's private and public, and then there's grant, concessional, equity, and debt. As they stand, they can be used on a pure basis where the opportunity exists for internal viability in projects, for example, or find a way of blending them so that early stage development of projects can also be facilitated as we move forward. And then, of course, the topic of today's conversation is institutional investors, and here we need to find a way of ensuring that either in the primary market or in the secondary market, we find a way in which to package opportunities, particularly for long-term investors, to begin to make financial and capital contributions as we undertake this journey. I'm going to very quickly run through this. A number of enabling as well as constraining elements exist as we undertake this journey. In the prudential and regulatory environment, there's clearly the issue of risk management as it relates in particular to our banking sector. And here, both the Reserve Bank, but more importantly, National Treasury, together with industry, is beginning to look at what climate finance risk looks like, not only from the point of view of a future risk to society, to economy, and to the banking sector or the financial sector, but also the way in which we begin to look at climate risk as a thing that we need to consider in our portfolios. Capital adequacy rules might change as we move forward, which then means that we have essentially an incentive, disincentive type mechanism to ensure that we compensate or transform our portfolios towards greener forms of exposure. There are concentration risks, and then of course, as far as reporting and disclosure are concerned, both the industry, the banking sector, as well as National Treasury are beginning to look at what the requirements for reporting and disclosure would look like, so that in particular banks and companies can begin to ensure that they report in a way that shows the true extent of their contribution to decarbonization or their carbon intensity. Fiscal and economic environment, I'm not going to go into too much detail. I think we're all familiar with the kind of constraints that we have. Then, of course, a need to reconcile and harmonize public policy, which sometimes, as we know, can be quite contradictory. And here we're talking about environmental policy, which in essence will become established as a statute in our climate change bill, but managed and administered by the DFFE. Industrial policy, very important as we undertake the journey towards a greener future, and as we ensure, of course, that we have growth that accompanies this decarbonization pathway. Minerals and energy, don't need to go into too much of detail there because of the issues related to both the coal value chain as well as energy in terms of providing better sources of renewable, primary energy from renewable sources for our power sector, transport, and then of course public policy as it relates to tax. And as we know, National Treasury is beginning to look at how it can more effectively ramp up the carbon tax. Technology development, I've talked about in a little bit of detail already, so I'm going to skip that, but hugely important as we try to find mechanisms to crowd in early stage investments in moving us up the technology curve, especially as it relates to mitigation. Return on investment, internal rates of return and investment mandates, also very key to ensuring that the financial and investment community moves along with us on this journey. I think transformation needs to happen in the sector's readiness to meet this challenge. From a governance point of view, there's a lot of focus now on environment, social, and governance, and with, in my view, environment beginning to occupy increasingly a weightier portion of that consideration. I'm going to end with this, which appears to, well, it frightened me initially as well, But this is quite interesting work done for the 2017-18 financial year by Green Cape, CPI, and Bertha in their South African climate finance landscape. I'm going to leave this up just for a short while. Safe to say that until now, we've been reasonably successful in getting finance, capital, and risk equity concentrated into mitigation. And this is no surprise, because as we know, as we move through our REAP programs, there were a lot of incentives and risk mitigation that accompanied the development of the generation sector as it relates to solar PV and wind. We're going to have to find a way of ensuring that many more resources, both from source as well as to destination points, get mobilized and allocated in the areas of adaptation and just transition. And it will be quite interesting to see how we as a country can provide the recipient conditions that are necessary, in particular for global and domestic private capital, to begin to get crowded into the various pathways that we need financing. Steve, thank you very much. I'm going to stop there. As I indicated earlier, I will remain on the line for a while, but I have to leave at 10 o'clock. Thank you very much.
Thanks very much, Deepak. Great scene setting there and some really useful kickoff data. If I could please encourage people to ask questions in the Q&A box. So Rulani has kicked us off. Thanks very much, Rulani. Please feel free to do that, and we'll answer those questions live as we go along, and also maybe use them to drive some of the discussion at the end of the presentations. So I'm going to hand over to Nazmeera Muller to give us her perspective. So Nazmeera is the head of South African investments at 91, responsible for their competitive investment performance. She was also the co-head of South African fixed income. She's passionate about making financial markets work to support development. And as part of that remit is working with the Emerging Africa Infrastructure Fund, which provides debt financing for projects across Africa. And she's also responsible for the broader sustainability initiatives at 91. So thank you, Nazmeera. We look forward to your input.
Thanks, Steve. And thanks, Deepak, for setting the scene. I mean, I think the work that the PCCC has done over the last year has been quite amazing when you see the distance South Africa's traveled in our approach to climate change over that period. So I think I'm going to take two approaches to this. One is to talk through how we're thinking about what needs to be funded in a just transition for South Africa and where we think the mechanisms are available and where it's still an open. But the other, where I'm going to spend the bulk of my time, is a little bit of a different approach. Because what we've been doing as a business is we've been spending quite a bit of time engaging at a very macro view with global asset allocators, global pension funds and asset owners around how they think about just transition in emerging markets and how they support that. Because we think there's some real risks around those flows if the net zero pledges are implemented in a very blunt manner. So to start off with, on the essay portion, what we've come down to is there are essentially four components that we think need to be funded in order to achieve just transition. And Deepak's run through many of them, which is the new infrastructure that needs to be built, which is whether that is new renewable infrastructure, new storage, whatever that may be, and that the private sector seems quite able to do. Deepak's already alluded to the fact that the funding mechanisms need to change. The guarantees that are put in place can't be as generous as they've been historically, but the private sector has become quite equipped to deal with that. The second portion is the expansion of the grid in South Africa in order to facilitate all the connections necessary. And this means funding Eskom, which comes with all of its own complexity, but there are paths to doing that, which are already being worked on. I think where the difficulty comes in is the last two components. The third one is this idea of just transition. How do you take care of the workers who lose jobs, the communities that are impacted, where the coal mines were situated, for example. And there is no scalable model that we've seen. So Sandy's been doing a lot of work on this, but it's something that we continue to engage on, because we do have some long-term funds that are interested in trying to do more in this space, but they are, after all, commercial funds. They are the assets are owned by pensioners or people saving for their pensions. So we need to think about how we protect them in this, and that's where blended finance could potentially play a very important role. The last one, which is a discussion which has surfaced in South Africa over the last couple of weeks, is if we want to retire coal-fired power stations earlier than their useful life would dictate, how do we think about compensation for that? And that, I think, the world is still in its very early stages. So let me just park that there for now, in terms of saying the first two components, we at 91 think the private sector is quite ready to fund. The last two components is where much more work needs to be done. And then move into this idea around what we see happening globally at this point as we think about emerging markets like a South Africa or an Indonesia, or even in India to a certain extent, so heavy emitting emerging markets, and what that looks like. And I think one of the perhaps context that's useful is if you look at our assets currently, it's almost 60% in emerging markets, 25% in South Africa, 35% spread across other emerging markets across the world. And that's why we approach this as very much an emerging market issue. And this is some work that our emerging market debt team has been done, which is what the fair share emissions should look like if you adjusted for development income thresholds and progressivity. And what you end up with is, for a lot of lower middle income countries, that there shouldn't be any adjustment to their threshold emissions relative to the baseline. For upper middle income countries, they would still have a number of years before they'd need to reduce. But in order for that to happen, is you need to see the left-hand side, which is this very rapid decline from high-income countries. And we know that's not possible. So the result is, from the IEA on the next slide, is what we need to see happen is a massive increase in investment to emerging markets and developing economies in order to achieve these net zero emissions by 2050. First bar on the slide is what the average investments across various energy sources has been like for the previous 5 years. The second bar is what is projected, what countries have committed to doing. And then the third and particularly the fourth one is what needs to be spent in order to achieve net zero. And the problem is that if we don't find a more equitable way to do this, what we are worried about is what you're seeing from a number of asset owners, particularly in Europe at this point in time, is an almost linear application of net zero. So what we're hearing some of our clients saying, so we have quite large clients from Northern Europe in our emerging market debt funds, and they're saying, yes, we know we need to think about transition, but please can you reduce your portfolio carbon by 7% a year? This is an emerging market credit fund. Please can you reduce your portfolio carbon by 7% a year? And if that's what you're going to do, one of the easiest ways to do that is just sell your high emitters. But that's not going to solve the problem for emerging markets in terms of facilitating their transition, and it's not going to actually result in any reduction in carbon emissions either. And this is the conversation we're actively trying to have with our clients at this point. I mean, what we've seen happen, and these are more developed market examples, except for the Anglo one, but what we've seen happen is a number of big energy companies just divesting their dirty assets. And what we're trying to prevent is a move from asset owners globally, where they start to say, just divest your high emitters. If we look at the All Country World Index from MSCI, if you were to simply delete emerging markets from the MSCI ACWI, you would reduce emissions by 10%. So you can see it's very easy to just say, let's just make certain markets uninvestable. And as I said, that's not something that we think actually amounts to very much. One of the big companies in SA that we're spending quite a bit of time with at the moment is Sasol. The little graph there shows you the difference between Sasol's emissions, its carbon intensity for scope 1 and 2 versus the MSCI ACWI. And again, the easiest way for our emerging market credit fund at this point in time to achieve this 7% a year reduction in portfolio carbon, so 21% over the next 3 years, is sell all of its Sasol bonds. Takes care of the whole problem. So very easy to achieve a portfolio target, but that's not going to deal with the real carbon issue, but it's also not going to be a just transition for Sasol or South Africa, because Sasol produces 1/3 of South Africa's fuel. It's a big contributor to the tax base, produces 50% of its explosives, 50% of our chemicals. So it's a massively systemically important company. And unfortunately, most of these products come out of Secunda, which is the highest single point source of emissions in the world. So working with Sasol to understand how they're going to resolve this issue, I think is vitally important if we think about just transition on a macro global basis, rather than saying just sell all your Sasol bonds and don't fund them anymore. How we as a business are thinking about how to support an inclusive and fair transition. Effectively, we're breaking it up into advocacy, so this idea of encouraging energy transitions, but also measuring transition, and I'm sure Sean will talk much more about this, is how we think about measuring transition rather than just portfolio carbon intensity, and then focusing on the transition plans of the heavy emitters, working with companies like Sasol. And then the last bit is on an investment basis, like what are we trying to do? Is we trying to develop transition-centric investment strategies. And that includes supporting transition in our big public market strategies, because ultimately, if we're going to solve this, it's always tempting to focus on private transactions because you can structure them and you can introduce covenants into them and you can require reporting. But we need to bring the public markets along as well, because that's where the big pools of capital are. You need to bring the public markets into how you fund transition. And that's what we think is particularly important at this point in time. Steve, shall I leave it there? Since you switched on your video, I take it that means I'm running out of time.
Yeah, it's a small thing to say you've run out of time. Yeah. I think that was a great intro, so I appreciate that. And I think we can pick up some of the points you want to make in the question and answer session. So thank you. So our next speaker is Sean Kidney. I'm sure will be known to many of you. Sean is the CEO of the Climate Bonds Initiative, which has been working to mobilize capital for climate action for a long time now. There are about $34 trillion of assets represented on their board. And Sean has a unique perspective because he works across a huge range of countries, including Brazil, Mexico, Asia, and Africa, and has also been working with Treasury here through a project that the NBI and the Carbon Trust are leading on green finance taxonomies here in South Africa. And he's also a professor in practice at SOAS, University of London. So Sean, I welcome you to make your comments. Thank you.
Hey, thanks, Steve. I'm going to try and get a bit short so we can get into discussion. I'm not going to talk about the things I normally talk about, EU taxonomy or green bonds. Just suffice to know that we've got a case study of how to create a market around a policy area that has expanded enormously, been very successful, and there are lessons to be learned there, because this is a public policy problem we're talking about here today. We've also got a market that we can expand to include the agenda we're addressing here, and need to necessarily. And I want to talk a little bit about that. In growing the green, in fact, green and sustainable bonds, the daughters of green bonds are things like social bonds, very close to what we're talking about here today, and sustainable bonds and so on, and blue bonds even from the Seychelles. We've had a couple of key principles. This is a market that's currently about $2.5 trillion US outstanding. It's grown from 10 billion outstanding 10 years ago. So it's a fairly large growth. And we do expect growth this year on last year's issuance of about 80%. Next year, we expect it to be similar. So there are some key principles in what we've done. The first one is you've got to meet investor requirements and risk yield. When I started in this process some 10 years ago, the discussion about investing in climate was dominated by discussions about we've got to get investors to take the risk. Now we've got to put together a product which exposes them to the risk. And I still get these discussions from a lot of people. We've got to expose investors. If they're not taking the risk, it's not real, or something like that. There's a moral imperative. But, you know, At the end of the day, pension funds and institutional investors, insurance funds that we work with largely, who have most of the world's money, have very clear risk yield requirements, and often they're regulated. So if you're not meeting their requirements, you're just not going to be in the game. So when we looked at the public policy requirements, the green stuff and so on, it was very much an add-on to that market. It wasn't core to that market. In other words, we said, we're going to meet the risk yield requirements, and then we're going to address the climate issues. We didn't turn it the other way around, which is these are investments that will help you meet the climate change and save the planet, but you've got to take a haircut. Very key points about all this. The second principle that we did was to make it easy to know what to do. We needed to listen to the science. Now, that's something that while we have been working resolutely on at climate bonds for many years, we've only in the last few years been able to bring into government. You know, I still think about the early days of the EU taxonomy, that word again, when we talked about listening to the science and adopting IPCC targets and realizing that the Commission was not there, was not yet thinking about meeting the Paris Agreement so fully. It took another 3 years before the Commission caught up to that. And now the European Commission, European Union targets are consistent with what in our taxonomy working groups we had been talking about for 3 years. I'm going to say, come what may, if we want to future-proof what we're doing and ensure longevity in financial instruments, investor appetite markets, we've got to be thinking about the future, and we've got to look at what the science says about this. A key principle. And then the third principle is then you preference the hell out of it. Now, what does preference the hell out of it mean? Well, it means that when you're looking at financial instruments, you look for ways to pick up the risk factors that will allow an investment to meet the risk yield requirements of a pension fund or an asset manager or a fund manager like 91. That's the key point. So we don't do this with the private sector alone. Most of what we have to do is fast. Like this is, we don't have any history of risk. We can't get S&P to do a credit rating on a just transition investment in South Africa because it doesn't exist, has never existed before. However, that doesn't mean we can't get private capital. It just really means we need to package and engineer the investment opportunities, because these have to be investment opportunities. There's not enough public capital to do it. God knows in South Africa, that is so true. It is stretched to the gills. We have to do it in a way where we package it to meet those risk yield requirements, where we address enough critical risk issues. Now that's engineering, financial engineering. It's an old science. You know, I'm reading a book at the moment about the history of debt capital markets in the US. For 200 years, the US has used selective guarantees to make sure money goes into public policy priority areas. In one case, in the slave states in the Confederacy, Louisiana wanted to support the slave industry, and so they had securitizations of slaves guaranteed by the state. Would you believe? Bizarre what this history is like that we're looking at. The key point is there has to be a slice of public sector support. Now, the unusual opportunity we have in South Africa, the unusual opportunity, which frankly has not existed as much in the past as it does now, is the ability to get the support of government of states from other parts of the world, OECD countries specifically, because of the nature of the climate agenda, because of the need to ensure rapid shifts, because of the now substantial and ambitious commitments to the 2030 agenda by all the major economies of the world. That's actually underway. That's happening right now. Now, because of that, that's changing the goalposts in Europe and the US, changing parameters. People are now thinking, okay, I can do something. I need to do something. What am I going to do? Well, what are they going to do? One of the things they can do is they can provide levels of guarantees as a foreign country through the KfW, the European Investment Bank, or the IFC for investments in South Africa. I mean, we have a long history of this, right? In the bond area, the first Joburg bond was 45% underwritten, or a first loss guarantee provided by the IFC. It got a credit rating higher than the South African government. Whoa, they did sell. It was fantastic. Now, once we got Joburg going, they didn't need to do a first loss provision the next time they did a bond. When they did a green bond, in fact, it sold like hotcakes as well. No guarantees. Selective use of public policy financial support instruments or measures is the secret in going forward. Once we know what to do, I'm going to come back to that in a minute. Now, public policy measures don't need to be guarantees. They can be regulation, if you pass a regulation saying this is no longer happening anymore, as Europe did for incandescent light bulbs, it makes the investments in LED light bulb manufacturers look a lot rosier suddenly and sucks in money. There are things like that that we can do. Policy certainty going forward is obviously a key part of this. In Europe and the US, where it's now very clear that the administrations are beginning to take strong and concerted action around climate agendas, investors are saying, okay, well, that cuts out a whole realm of investments that's going to be safe from policy action now, isn't it? What does it look like? The taxonomy, by the way, represents investments that are low risk, that you can safely invest in because they are very unlikely to be negatively impacted by policy action. I mean, hey, you can't rule out a Trump or like that. Things happen. We all know that. There's risk involved. We're risk people here. But we're talking about minimizing forward risk. And that's why in Europe and the US, things that are in the green bond market get a lower interest rate than things that aren't, even though they're the same credit rating theoretically behind them, because they represent investments in companies or activities that are seen to be lower risk going forward, or companies that are taking action to reduce their risks against the policy changes that are happening going forward. Now, what we have to do is manufacture those things, I would argue, in this agenda. So because we've created a successful market already, green finance, sustainable finance, it is successful. South Africa missed the boat the last few years because ages ago, it was one of the leaders of green bond issuance around the world with Nedbank and others in the mid part of the last decade. But it's getting going again now. But the main thing is the global market's getting going, an entirely different context to what it was 5 or 8 years ago. We do need to be clear what to do. Now, I'm here not going to stray too difficultly into the policy questions facing us in South Africa about just transitions. It's hard. You know, Nazmira has talked about the challenge of Sasol. Again, an extraordinary interesting case study. We're following very carefully what's happening. We need to understand what transitions are. For taxonomy work, for green definition work, we have now got a whole work stream around understanding what transitions are, understanding that companies that might start off being very high carbon, I think Sasol might be the most carbon intensive company in the world at the moment, but if they've got an ambitious transition that is consistent with what we want to get to, we need to support, we need to encourage, we need to include them in this broader sustainable finance market. We can. Now that will also apply to just transition investments, in my view, if we can package them as investable propositions. If we can't, well, it's not a conversation for this group. It's a conversation for government, and there will always be measures along those lines. But of course, we're heading into a world of extreme climate volatility starting this year, and that's going to get harder. So government expenditures are going to be more and more having to be allocated towards dealing with emergencies, dealing with crises like the pandemic, but there'll be others coming through too. So where we can get private capital, we need to. And that's, of course, the challenge. We only make this change of a close working relationship between public and private. There's a lot of stuff that government has to do, a lot of stuff that has to improve how it's doing, by the way, of course. But at the end of the day, some risk will have to be taken by the public sector in different ways to make sure that investments will work for the private sector. The only question is which particular public sector, which is the opportunity we've got. Who would have thought we could get the Germans to provide guarantees for green investments? Well, we can. Who would have thought we can get the Americans to do it? Well, we can. They're doing that around the world right now. Yesterday, I was on a conversation in Mongolia. The extraordinary range of renewable energy investments that are being supported by the US administration and by the Chinese administration, using things like guarantees, et cetera, et cetera. So, but we've just got to package it right. We've got to say it. Now, when I said earlier, we've got to make it easy what to do.
Time check, Sean.
Last point,
Just
make it easy what to
minute.
do. We've got to have ambition that is in line with what those governments want to do. So when we look at things like the Sasol transition, or the transition of Eskom, or the transition of the South African mining industry, we've got to bear in mind what's absolutely essential to do from a climate before we package and sell. We don't have the luxury at Eskom of keeping those coal plants going till 2050 if we want to get international money. Ain't going to happen. We've got to have a more aggressive plan consistent with international trajectories of change to then take to international investors to say, this is the support we need. That's the key point. It is not about keeping things as they are. It is not. It is about properly transitioning to something entirely different. That's the art of it. But for discussion, Steve.
That's great. Thanks very much, Sean. And also a great segue into this conversation around international support and what other countries are doing. So I'd like to invite Johan Florin to speak next. He's chairman of the Sweden's Sustainable Investment Forum and chairman of the Amnesty Business Group in Sweden. And so doing a lot of work in this particular space. And just for reference, AP7, this is the 7th AP fund, is the default alternative within the Swedish premium pension system with assets of Great British pounds 75 billion with 5 million savers. So a significant asset owner, and interesting to hear what you have to say. Thanks, Johan.
Thank you. Let's see if I can get my presentation going here. So I'm just briefly going to give you, we're a sustainable investor, and I'm going to give you our overarching philosophy briefly, and then I will get into commenting some of the prior presenters here. So see if I can get this going. So with the default alternative, we actually now have about $90 billion asset under management. We're a very small fund if you look at the staff, so we have a lot of money, but small staff, and we've been doing ESG in some form from the start 20 years ago. And our overall philosophy, and that is our vantage point, is as the universal owner, and this means that we own a thin slice of the whole global economy, 50 markets, all sectors, etc., etc. And so when we approach sustainability, the natural problems that we try to deal with are the systemic ones, the ones that threaten the whole system, that are unhedgeable, that will have severe impact if we don't solve them for generations to come. And in doing this, we try to collaborate as much as possible, since even in our kind of business, no one is strong on their own. So collaboration is key if you want to have an impact. And the good thing for us is that there are other universal owners around the world, pension funds, for example. And we all own the same companies, and since we're not we're not doing business, we're a government pension fund, so there's no competition. So we can easily collaborate on global standards and norms and things like that. And so this is a very central part of what we try to do. We try to collaborate and agree on what kind of rule would help a sustainable development in the world. We also, with this investment approach, which is buying the market, there is no exit plan in individual companies. We sort of buy them and just own them forever. And we also, our portfolio looks like reality in some sense. So if there is a problem out there, we're going to have it in our portfolio, and this give us the opportunity to work with the systemic ones. If you have a very concentrated portfolio, you have to focus on the companies you own, and someone else has to take care of the big problems. In doing this, we have a toolbox, you might say. So we're very active owners. We are voting on all the companies we have. Last year, it was about 4,400 annual meetings. We also file shareholder resolutions. We engage with a couple of hundred companies on particular topics where we think they can improve, and it can be everything from poorer reporting and transparency, and all the way up until we're about to blacklist them for unacceptable behavior. So before we do that, we always have a more intense engagement dialogue and sort of informing them this is what's going to happen unless you change. Last year, we blacklisted 84 companies for breaching international norms regarding human rights, environment, labor rights, corruption, things like that. And we also do some securities litigation, legal processes, and we have 16 of those going right now. And I'm going to give you a few examples before we get into the investing part. So engagement, this is probably the biggest engagement project ever seen going on right now. I'm sure a lot of you have heard about it, Climate Action 100+. It's part of the whole transition movement within our industry and society, you might say. So everybody's pinpointing a specific company, working with them for 5 years, trying to get them to reduce their emissions, to develop governance and increase transparency. Within this collaboration, which is unique in the way that global investors are collaborating, we've never seen anything like that before. And there's a similarity to the Paris Agreement. We never seen that type of global collaboration regarding climate on the political level before. So these things brings hope, I think, because I think it's necessary. As long as everybody's doing their own ESG work, it will not be very effective. But another part of it has a lot of spin-off effects with different projects and think tanks and knowledge hubs, and it's building a global infrastructure for collaboration. So this has already started other types of initiatives that are similar. One of the most recent one is TNFD, which is a spin-off from TCFD. So the first is TCFD is for climate, and TNFD is for nature and looking at biodiversity and things like that. So I think we will see in the coming years a lot of these types of collaboration projects. So this is an example of blacklisting. When we introduced the Paris Agreement into our norm base, we have a norm base that we start with. A couple of years ago, we blacklisted Exxon for their long-term efforts to, sort of counter efforts to climate, to dealing with climate change. There's another example there. It's kind of funny. It's a Swedish pension fund that blacklisted a Korean firm for alleged human rights abuses in Peru. So this is very global, as you can see, and that's from last year. This is an example of securities litigation. I'm sorry, there are some Swedish press clippings there, but there's also an international. So we took Alphabet, which is Google, to court for sexual harassments they had internally that they didn't deal with in a very good way. And we finally reached an agreement, which is the normal thing in these litigations cases, where they set up a program with external experts and the CEO involved, and they put about $300 million into this program to deal with their problems. And they also stopped the possibility to, buy. This has to do with a lot of their managers, and so when they have a problem, they buy them out of their business, sort of. But they stop this opportunity. So this was a great example. It's on the social side, but we also have litigations going on with GE and Goldman Sachs in Malaysia and Volkswagen for the Dieselgate, etc. Here's another global project called Corporate Climate Lobbying. It's a real barrier to dealing with climate change. And it's basically corporations funding organizations that use aggressive lobby tactics to stop effective national legislation when it comes to climate. And you can see this report, it's on our website. So when it comes to investing, and this is where I will hand it on to you, Steve. But first, just a couple of comments on what Nazmir and Sean said. To start with, the situation for us as sustainable investors is kind of, it's very strange. There is actually not enough to invest in. Everybody, all the sustainable investors want to do more green investments and also other sustainable investment, but there's not enough to invest in. And the consequence of this is that a lot of the time you actually get your conditions, if you buy a green bond or if you're looking for green projects, you don't get market rate returns. It's still just a few basis points, so it's not a big difference, but the demand is actually bigger than the supply of green investments. And this is very strange because there's a lot of need. So there's a link in between here. And I think Sean was going into this. I mean, how can we meet these two demands, the demand for investments and the demand for green investment opportunities? There's something in between there missing. A part of this, I think, is who is going to carry the risk. And every investor is, I mean, the question is risk-adjusted returns, not just returns in themselves. So you have to get a return that is market rate for the risk you're taking. And this is actually what we are looking for, risk everywhere, but we need to have returns that match the risk. Otherwise, the investment is not interesting. And this is a key point if you get into, for example, development banks, and if you look at blended finance and things like that. Private investors can accept very low returns if somebody is carrying the risk. And I think this is an opportunity that could be developed more. The EU is looking at it, but hasn't done that much yet. And we're going to go into that area more than we have historically too, to see how this can develop. My third and last point here is the net zero transition, and what Nazmira mentioned about 7% a year, and the goal is to have zero in 2050. I agree. I can confirm there's a real risk that this will end up in portfolio adjustments, reallocation from emitters to other companies with lower emissions. Nothing has changed in the real economy. It's only portfolio adjustments. So we are actually kind of lonely because we are writing our own ICAP at the moment. So we're going to have this plan, and we're emphasizing that the only interesting thing is for real emissions to go down. So if we're going to be a part of the solution in doing this, we need to own these companies, because active ownership is the major tool. So we have to engage in companies that are on a transition journey, which means not picking the most with the best ESG profiles. Thank you.
Excellent, thank you. That's fascinating. And I think this point that you raise about there are risk and opportunity in capital markets. If you get this badly wrong, you're going to find yourself on the disinvestment end of the spectrum. If you get it right, you can have access to greater capital. And you make this point that others have made, that's actually what the shortages on what to do, not necessarily on the finance necessarily. So our last speaker in the morning, and we'll open up some questions, is Sara Tassa. Sara works at the Ministry of Economic Affairs and Employment and the Department of Innovations and Enterprise Financing in Finland, and is a specialist in bioeconomy, circular economy, and climate actions. She's the chairperson of the Developing Finland Sustainable Finance Ecosystems Project, which I think she will talk about a little bit in the presentation. So over to you, please. Sorry.
Thank you. And I was hoping that I could turn my camera so that I could share you the beautiful autumn colors we have outside. But it seems to be that the wind just came and all the leaves are gone. So we are turning to this very gray mode. I think, do you see my PowerPoints now?
Yes, thank you. You can see it.
Yeah, thank you. Okay, so thank you for all the interesting presentations and thank you for this possibility to join you. It has been very, I would say, lively discussion, not discussion, but the presentations, and I hope the discussion will be lively too. When talking about sustainability and funding of, or even a smaller part of it, the green funding, there seems to be a lot of words, meanings, beliefs that needs to be better defined and open for common discussion and understanding. And there are also many things that you need to prove if you want to be sustainable. Some of them are very abstract, and in order to qualify yourself, you need a lot of stuff to get the funding. There are standards, there are labels, there's this taxonomy as mentioned, and so on. And this is a challenge for the companies, as well as for the investors to understand where we are, what this all means. And as a conclusion, many countries have made roadmaps and to adapt I would say, this new normal. This is what the funding will be. Also here in Finland, we have wanted to study what kind of platform would help the actors to come together as a collaborator team, or as the new word today, ecosystem. So we got the funding from EU reform for this project. And the objective of the project is stated here, but for me, working my hands-on in circular economy, this has come so concrete. We need a new way to approach financing in many ways. We have business models, new business models in circular economy. We are sharing. We have so many other ways of doing things, and high demand for digitalization, so on. And I can see very potential projects very often that are not bankable, as the terms today, what means bankable. And then I have a lot of interested investors to looking for good projects, but for some reason they don't meet. And we need a new way to get ideas together and money for these ideas. And in the sustainable funding ecosystem, companies and investors can meet and continue development work together and grow together. I think that is also important to note, that they are learning from each other's point of view, and they can invite other stakeholders involved so that they can have the big sustainable picture there. This is not a new funding instrument. There's no extra money, but the platform to bring public and private funding together and develop it further. So we have this national SDG finance roadmap, and it was launched only 2 weeks ago, so this is very fresh. It is not meant only for our national purpose, but I hope that because it is also funded by the EU, we can also share with others and find some common working platforms there. We already have some findings and recommendations for public sector and other stakeholders, but more is coming up with 4 pilot ecosystems, as you can see here. Now, the pilots were selected in the large, nowadays virtual workshop, and they were not very easy topics for Finns. The purpose is that these pilots will point out possible bottlenecks or catalysts, needs for stick and carrot, if I may say so, and also implement the sustainable way of thinking deeper for our systems. The topics here are carbon neutral society, and in that topic we are now considering offshore wind power. We have a lot of wind power also inland, but now how about offshore? Then we have sustainable water solutions, huge amount of interesting technologies and solutions in Finland, but how to build a big picture of those, the whole system, it seems to be the difficulty here. And then equal learning opportunities, it is something that, well, Finland is known as a good from our good education, but how to share it with the others, and maybe even make business of it. But anyway, and food system on protein production and new ways on there. Let it be new ways of fertilizing or new ways of using carbon dioxide from the air. There are a lot of ideas in here. And the journey continues still, and we hope that the pilots will take off, not just being this short project, but initiation for something a bit larger. And the project will continue to collect the feedback from these pilots, and several workshops still coming up to further develop the guidelines for EU, for us in Finland. And it should also create a useful toolbox that include not just this kind of platform to get together, but most important international regulations and requirements for funding, for sustainable funding, like UN Sdgs or EU Green Funding Taxonomy. So how companies and investors should talk about this, what kind of proof is needed, and it should help the collaboration and to fulfill most of the requirements. As we know that South Africa has also this kind of roadmap, and South Africa is also one of the EU strategic partners, I think we have a lot of possibilities to collaborate this in the future. So this is kind of the shortly what we've been up to, and looking forward to the discussion. Thank you.
Thank you very much. And I think a very useful connection to the SDGs, and the SDGs then becoming a proxy for all of these social and environmental and governance issues that then pull around this concept of just transition. So I'm going to ask the audience to keep putting questions in the Q&A, and I think if all of the panelists can put their cameras on, we'll run into a little bit of a panel discussion now. People have been diligently answering the questions in Q&A by text, so the ones that have been asked have been answered. So invite a lot more questions. But maybe to kind of kick off the discussion, a couple of the panelists mentioned this idea of needing to know what to be done and some of the complexities in that. So pipeline seems to be a big problem, trying to deal with what to do. Johan, I think you mentioned that demand is bigger than supply. And so the supply problem is a big one, and particularly when we start to think about developing country characteristics here. So you've got companies that are suffering from underinvestment for the last decade, operating in economies that haven't been functioning very well, don't have very healthy balance sheets. If I think of steel, petrochemicals, mining, and there are a whole bunch of sectors that they can't necessarily borrow, yet need to invest heavily. And so what are some of the solutions that we need to think about here so that we don't run into these challenges around portfolio adjustments that we mentioned a couple of times, where it's easy just to, it's easier to take those people off your portfolio than to work with them, for example. So I'd be really interested in some of your experiences around that. I don't know who wants to jump off.
I can have a go if you want, and then.
Please, thanks.
I think that there's two strands of it for me. So one is how do we get more projects done? And I think both local development banks, but also the international multilateral development banks have a big role to play in improving project preparation. So it's not a funding issue per se. I mean, there are some areas where funding from them will be useful, whether that's in blended finance, as Johan said, whether they can take a higher risk portion of a transaction. So I think there is some use there, but I think the greater focus is in project preparation in terms of working with governments on their regulatory environments, standardizing regulatory environments. Because if you think about what gives investors confidence, Steve, it's experience. So the more you can have programs that roll out renewable transactions in countries with sort of standardized documentation or risk frameworks, the easier it becomes to invest and the lower the costs become as you move through those rounds. South Africa has a great example of this in the first 3.5 rounds of the REAP. We just, decided to press pause for 10 years on that. So that's one area where I think the MDBs and the local development banks have a really crucial role to play. But the other is this idea of, starting to measure transition. Because if you want to support companies that are investing to reduce their emissions, we then need some framework to get comfortable with what transition looks like. And I know Sean's doing a lot of work. I mean, he talks about the working group he's got going. He's got me to volunteer to be part of it. So I was going to use a ruder term than that. So, but it is this idea, we need a framework on how we measure transition. And, I think we all have some idea of what that amounts to, but it seems to be, are the targets ambitious enough and are they science-based? Are they achievable? Have we costed for it? In terms of CapEx, in terms of revenues, in terms of expenditure, and lastly, can we monitor progress on some sort of reasonable basis? And progress doesn't need to be carbon emission reductions in year one. It needs to be, is the CapEx being invested? Whatever is appropriate. But it's this idea of we need a framework to measure transition, because that's what gives investors the confidence that these projects, which emissions may not be going down, but actually are green in some medium-term format.
Maybe to follow on and maybe bring Sean in here, is that framework a taxonomy? Is it more than a taxonomy? What does that framework start to look like?
Well, unfortunately, there's a few things involved in it, the few moving parts, as there is always when you look under the hood, unfortunately. But the outlines are pretty straightforward, right? We need to know what to do. We need to figure out how to deal with the credit issues so AP4 can invest. Well, they've got a very low emerging market exposure, but so that pension funds and insurance funds can invest and other investors, and then package. And the key point that Nazmir is getting to is, and I think Johan said as well, there is extraordinary demand for green out there, right? It is a seller's market, guys, but you've got to be properly green. You can't, excuse the language, mess it up. So you've got to do it the proper way. And that's where taxonomy is useful, because it tells you what you can do. It tells you what you've got to do. It's a simple rule set. Hey, it's complicated under the hood. Okay, I get that. But it gives you the universe. So if you stick to that universe, man, have you got buyers out there? Now, you've still got to deal with some initial, some issues of bankability. Of course, that is, but there's nothing special about that. We've been doing that for 150 years. We know how to do that. It is a mixture of policy. All I'm trying to say is stick to the knitting, stick to this particular program, and then look at it. Now, the demand is giving a bit of price benefit in European markets and US markets. Just to Johann's point, it's not sentiment driving this, because in secondary markets, very clear now, we've got years of history, green bonds are outperforming vanilla bonds. They're just trading at a differential rate. So you can be a hard-headed portfolio manager, and it makes sense to invest in green bonds just because of the valuation, if you're ever going to mark them to market. So it's a very simple equation. It's a win-win in that sense. We are not getting investors sacrificing yield to save the planet. I will say AP4 has been very good on this issue in the past, but as a rule, we are not doing that. They are doing stuff which meets their risk yield requirements first, and then they're looking for green. Now, of course, the extra bonus now is that green's actually more valuable to them. In the downturn, in the collapse of bond markets in March last year, when bond markets froze in the West for about a week there, green bonds stayed liquid. Like how unbelievably good is that if you're an investor with a defensive posture and you need to be able to have a liquid portfolio? So you can sort of see why the benefits are. But so the first thing is we've got to look at what the universe is, and it's international work, taxonomy work. The South African taxonomy is absolutely consistent, a useful guide. The Treasury is supporting, etc. We then need to look at the bankability issues to meet the risk yield requirements of investors. That is, standardization is one of those things. Nazmir is perfectly right. But there's 1,001 case studies around the world now. Shop around, guys. Everything from M-Pesa, which, by the way, in Kenya is important, not just because of the access issue, but because you can get a FICO score out of the mobile phone records. So you can do securitizations of M-Pesa loans. It's fantastic in a way that you can't with other sorts of microfinance. There's tools all around the place at a micro level and, of course, at a macro level with everything from guarantees to other sort of stuff. We do need to look at the end of the day, though, about the economic transition of Africa, of South Africa. That's what it's about. The world is shifting, folks. It's shifting actually fast. We will, as a result of the 2030 commitments of the major economies, and let's face it, they drive the world economy, right? Of the major economies, we will see a few things happen very, very quickly. Renewable energy, electric vehicles, etc. There are implications for the South African economy, including the mining sector, that we need to address, plan for, and build investments to support, and think about what it means for our people and our education accordingly. That's the job. That's the hard job. So government needs to do. Think for the future, not look to the past, and then use all these tools. And hey, if you do that, the money's there.
That's great. Thank you.
Sean would call the EU taxonomy simple. I just thought I'd add that in.
Sorry?
Thank you.
I'm sorry, Nazmira. I tried to make it simple. We're still working on it. The EU taxonomy is not over yet, but by the time it's finished, it'll be simple. Steve, I've got an emergency in Brussels I've got to jump off to. I'm going to have to leave your panel, I'm afraid.
Okay.
I'm very sorry.
Oh, I'm very sorry.
I hope that
Well,
makes
thank
sense,
you.
though.
We appreciate it. Yeah, emergencies
Yeah,
in
Sean,
Brussels make sense.
thanks. Sean gave me good words to continue with, like demand. So if there's a demand, there's always then the way around it. And for example, in this workshop, when we were talking about offshore windmills in Finland, why we need those, it's really harsh conditions. They will be frozen during the winter, and there's no wind during the summer, and all this kind of discussion. But then we took to the table the company, steel producer, and they said, well, if we need to electrify our factory, we will be needing all the electricity anybody in the neighborhood can produce. So there's a customer, so there's a need. So there is a project that would be worth of doing. and how we can build it. It could be a business for somebody else too. So this kind of ecosystem thinking, taking different parties to the same table, understanding what is the challenge, what needs to be done, how the big picture works. I think it's part of the challenge, not just starting financing programs or not just starting projects, but seeing where we are going with it, or if there's a need of education. Okay, so where are they going to work? Take also these employers and employees from maybe from some other country to the same table and figure out how this education should be done. So I would say that collaboration and looking from the new points of view, electrification is and the mines are one big discussion also at the moment in Finland. So we will need new mines, but nobody wants to have a new mine in their own backyard, right? So how to deal this issue? What kind of new technologies, possibilities there are to solve this issue? And how to deal this, how the circular economies fit in, what kind of other projects there could be than just mining in that area, what it will bring to the area. So there's sustainable thinking, all these SDGs are very useful when you need to prove why to do this here. Of course, if it's a natural reservation area, I wouldn't put the mine in there, but are there ways around it? Can we go somehow underneath the top ecosystem in the top of the area, and how to deal with it? So I think SDGs are a very useful tool. Taxonomy, I'm not so sure. They go a bit too much in detail. So that taxonomy could be used as they are and not adapt too much in other things, like it is now adopted already in EU bioeconomy strategy. Before we had a taxonomy, it was in the strategy 2018. So there's a bit dangerous things ongoing, I would say, from the company point of view. But collaboration in this way and taking different kind of point of views, SDG is a nice help. Thank you.
Thank you. And maybe just before you jump in, Johanna, I would just put on Deepak's hat in his absence. Obviously, one of the things that the PCC is trying to do is that ecosystem thinking. How do all of these things fit together? What do we need to do? Sorry, Johanna, over to you.
Yeah, I think I catch on to the EU taxonomy there, and I'm not completely convinced either. We'll see where it goes, but I mean, there's been a lot of criticism and problems with it. And one problem is that it is a political process, which means that there are a lot of interest trying to influence the process from both left and right, both from civil society and from enterprise, etc. And that makes it sort of unpredictable. In some areas, it's watered down, and in other areas, it's too prescriptive in detail. So, but we don't know yet. So, I mean, we shouldn't. But there is a risk. An alternative that I think is very hopeful that was introduced in May this year by the investor agenda is that Investor Climate Action Plan, ICAP, and the expectation ladder that they introduced them. And this could be an alternative in the sense that it's more of a market-driven concept. And I mean, it's part of the net zero race, and to getting to net zero in 2050. And all the investors, I mean, we're working at it right now, and I'm sure the coming years, more or less everybody will have some sort of climate action plan among investors, sort of, at least if you have any sort of sustainable ambitions. And the good thing about this is that you have to report on your progress. And this is a reflection on Nasmira's comment that if improvements over time get into focus instead of portfolio footprint at the moment, this will open up for different types of investments. If you only want to lower your portfolio footprint right now, you sell all your utilities and you invest in banking and maybe some tech companies or something. And that is not very helpful. If you're looking at progress over time, you have to start with something that has potential for transition. And an idea that we have that we're working on right now, and we already have had discussions with several of our asset managers, is to, I mean, on a very simple level, the concept is take away all the best ones because the transition potential is low, and also all the worst, the laggards, because they are just hopeless. It's not worth the effort. And then in the middle, find the companies that are not the best ones today, but that have a lot of potential for transition. This would mean, and then we try to combine active management and active ownership. So we pick companies that we think have potential, and then we engage with them to speed up the process. For the companies, this would mean that it opens up a new opportunity that you don't have to be great when you start, but the important thing is to have a convincing case that over the coming years, we will become much better. And we want you to invest in us because we have this potential. So, and I think that is in particular relevant for emerging markets. We are actually overweighted we have the All Country World Index, and we are overweighted in emerging markets. So we are very much thinking about this because it affects our carbon footprint, our portfolio footprint. And we get a lot of questions about this. So I think market-driven initiatives to measure the progress in companies that are on a transition journey would be very helpful.
Great, thanks everyone. I think that's been excellent input. I'm conscious that we're nearing the end of the time that we have, and we haven't been able to get to all of the questions, so my apologies for that. There's some interesting thoughts from Jonathan first in the chat around blending and the role of different financial institutions, and maybe some cynical observations about the markets. But you know, we would love to have the time to get into more of that. But I think we've probably reached the end of today's session, and it's been a really great session. I really appreciate the panelists and the insight that you've provided. And to those that are absent. And so the process from here is we will write up a summary report from today. We will share that with everybody, including the presentations that were given. So, and if the panelists could please share their presentations with Sandy and the team. And then tips will circulate that to everybody once that's complete and give you a chance to review. And certainly from my perspective, a really great summary of the kind of the key issues and the key challenges. I don't think we necessarily got into some of the solutions on the project development side, but we hinted at them, and perhaps that's a topic for the future. So I'm going to give each of you 30 seconds to a minute just to wrap up with a final thought, and then we will close the session. Thanks very much. So I'll start with you, Sari. Sorry, can you hear me? We might have lost you. There we
go.
Go.
Now you can hear me. Yeah.
Yeah, just a last thought from you.
Yeah, it was very great to participate, and at the same time, I would like to comment that tomorrow I will participate on South Africa, Finland senior officers economic consultations. So the discussion continues in several levels, and I'm looking forward to the possibility to work in this north-south axle in this issue, because I think we are sharing quite many same issues and hopefully find solutions together. And this is not easy topic. This is needed. The need is there for the systemic change, and I think Johan was talking about it in a very practical way. What needs to be done, and the funding is there. if we figure out how to combine public and private funding, and these instruments need to be developed together, and the regulation is not always there ready for this, so we need to develop that also. Thank you.
Thank you very much. Johan?
Yeah, my last comment would be that if we're looking at just transition, it's two parts, and one is the transition in itself. And if you're an engineer, you can have the idea that if we get the perfect algorithm and just the technical solutions, this will work out fine. But if you look at just transition, you're putting society into the equation, and so the engineering solution will not work anymore because people are involved and a lot of different interests. And so I think and clearly there's not going to be a transition if everybody's not on board, or at least the majority. So and emerging markets is just a very big part of this, what you need to solve for to be just. And I think one of the most important thing is to get away from bilateral efforts to solve things in small projects. I think we need global forums where all the parties can get together and agree. And there's nobody know how this agreement will look in the end. You only know that you have achieved it when the majority accept it, sort of. So I mean, in the finance industry, it's very easy to start calculating on things and trying to find out, to predict this is how it has to go. I think if you put the social aspect into it, it's much more a sort of a negotiation process, and it's about when a majority accept it, we have found something that we can work with. Thank you.
Thank you. Thanks. And Esmira, the final word.
I'll try. I've talked a lot already, so I'll try and be brief. I think the key points that I think are important have been touched on in the discussion. We need to improve the project flow by using the MDBs more in terms of doing that. But I think what that also does is we need to reduce the difference between perceived risk and real risk for emerging markets. Because often the perception of risk for lots of these infrastructure projects is a lot higher than the realized risk has been. The actual default rate is much lower. And I think the only way you're going to close that gap is actually getting funds into the market. And yes, in the first 1 or 2, you are going to need some first loss support, but I would hope over time that requirement disappears. But we need those examples to come into the market. So that's point 1. Point 2 is this need to make sure we involve public markets in this discussion. We are not going to solve transition in emerging markets with private markets alone, as much as the bankers would like to tell you that's the case. Lastly is this point around shifting the discussion from portfolio carbon to transition assessment. We cannot say that enough at this point in time.
Thank you. That is an excellent summary. So you've done my job for me very well. So yeah, just left for me to thank everybody. A really, really interesting panel. I particularly enjoyed it, and look forward to discussions with all of you, perhaps on future panels, but also individually. And thank you to everyone who attended. We appreciate it. We appreciate your questions and your interaction, even if it was in this unpleasant online way. And we look forward to being with you in future events. So have a wonderful day, and thanks very much. And look forward to future engagements. Thanks, everyone. Bye-bye.